Okay. Now, what do I mean by revenue? Now, see, revenue is such an important thing in the financial statements that we have a separate standard for this. Okay. Now, what is actually revenue? It is any income received. Won't just say received, income received or generated in the ordinary course of business. Okay. Income received or generated in the ordinary course of business. Now, let us say my business is to deliver lectures. So, any income that I receive or generate by delivering lectures will be my revenue. Okay. So, how do we record this revenue is something that we will be looking into IFRS in this chapter, IFRS 15. Now, try to understand one thing. Let us say I have my non-current asset in my balance sheet. I have my non-current asset in my balance sheet. Okay. Let us say the carrying amount is 1 lakh and the disposal proceeds, the amount or the price at which I sold this asset is, let us say, 1,25,000. Now, how will this be treated? Firstly, I will be recognizing the entry as, so I'll pass the journal entry only. Debit bank, 1,25,000. I will credit non-current asset. Credit non-current asset. How much? 1 lakh. That is the carrying amount. And I will be crediting my profit on disposal. That is PNL, 25,000. So conclusion over here, if I dispose of an asset, it is not recognized as revenue. Okay. So even if I'm writing this in PNL, this will be classified as my other income and not as my revenue. Because buying and selling non-current asset is not my ordinary course of business. Okay. Next thing. Hmm. Okay. In case of construction, no, it's not a non-current asset for them. Now, see, in case of construction business, the builders, they classify the flats or the particular bungalows as their inventory. So it is a current asset for them. It will be non-current for us depending on our use and expectation. But for the builders, it will be what I say is current asset. They will classify them as inventory. They always see the flats as an inventory, okay, and never as a non-current asset. Okay. And also, the revenue that I record is always on the net amount and never on the gross amount. Meaning to say, I record revenue on the amount excluding sales tax. Why? Because this sales tax is the amount that I collect on behalf of the government. Hence, it will be classified as a current liability. Okay. So, revenue should not include proceeds from sale of non-current assets or the sales tax. Okay. Any questions so far? Anyone? Any question? Okay. Now recognition. Now there is a five-step process if you want to recognize a revenue. Okay. Now let us understand this with the help of an example. Okay. Now IFRS 15 contract revenue from contract with customers says the following. Okay. That you have to follow the five steps. First one is identify the contract, identify the separate performance obligation within a contract, determine the transaction price, allocate the transaction price to the performance obligations in a contract, and recognize revenue as and when the performance obligation is satisfied. Let us understand this with the help of an example. What I will do is I will change the name over here. Isha went to cafe for a dinner. Now she ordered food. So what will happen next? Once you order food, the performance obligation of the restaurant will be to provide pizza and juice. Now, what do I mean by performance obligation? Something that the restaurant is bound to do. Okay, it is their duty to do out just because you entered into a contract with them. So their performance obligation is to provide pizza and juice. Now, before ordering, Isha will go through the menu. Obviously, right? We all go through the menu for one. Now, let us say she ordered pizza and juice. The total bill is 850. Now, what you will see is out of this total 850, how much is towards pizza and how much is towards juice. So let us say it is the price of pizza is 600 and price of juice is 250. Now, what will happen is once you eat your food, you pay the bill to the restaurant. They will then recognize revenue. See, I am talking from restaurant's standpoint because we are discussing the chapter revenue. Now, you went to cafe for a dinner. This is identify the contract. Now, see, it's not always necessary that you enter into a written contract every time. You want to travel in a flight, you book a air flight ticket. Now, what will happen is the moment you book and pay for the air flight ticket, it means you have entered into a contract with the airline industry. So it's not always necessary that you need to enter into a written contract by virtue of the customary business practices. Okay. Now I want to have a haircut. I will not ask my hairstyler to let us enter into a written contract first. No. The moment I step into a salon, I ask him to cut my hair. I have entered into a contract with him. Okay. So the first step is identify the contract. Second is identify the performance obligations within a contract. Now, what are the different performance obligations in this contract? To provide pizza and juice. Next, on the basis of this, the transaction price is determined. Obviously, on the basis of the performance obligation, the transaction price is determined. Now, see, transaction price, it is the price that will be paid by the buyer and received by the seller for entering into a contract, for entering into this transaction. Okay. Now, once I determine the transaction price, okay, my transaction price here is 850. Now, what is the next thing that I do? I split my transaction price to the separate performance obligation. Now, what is my transaction price? 850. What are my two different performance obligations? Pizza and juice. So, what I am doing over here is I am splitting it. How much for pizza? How much for juice? Now, as and when a performance obligation is satisfied, okay. As and when a performance obligation is satisfied, what we do is we recognize revenue. Okay. So keep this in mind. A place where students make a mistake. Okay. I'm telling you this again. When we solve an illustration, your ideology will change. So I'm writing a note over here that customer payment is not a trigger point. Customer payment is not a trigger point for revenue recognition. Meaning to say, if the customer has paid you money, you cannot say that, okay, let us recognize revenue. No, it depends upon the satisfaction of the performance obligation. So only when the supplier has satisfied the performance obligation, it can recognize the revenue. Now, in our case, what had happened was, let us say I had charged 50,000 for SBR, correct? Let us say I had charged 50,000 for SBR for private tuitions. Now, what happens over here is, before the lectures commence, I receive the payment from the student. So any money that I receive, I will first be showing it as advance received. I don't recognize revenue. Any advance that I have received, I show it as my liability in my balance sheet. Now, as and when the lectures progress, I am done with the syllabus. As and when I am done with this, what I do is I recognize certain amount into my PNL. So let us say I am done with the 50% syllabus. So what I will do is this 50,000, 25% will be shown as liability and 25,000 will be recognized as revenue. Why? Because I am done with my what I say is 50% of the syllabus. At time you will record half of lab, half the amount lab. No, no. So when I am receiving any payment, so what entry will I record is debit bank credit advance received. This is the journal entry that I will recognize. Yeah, paid in full. Hmm. Yes, yes. Now, why advance? Because, see, you have received money. You are yet to provide services in relation to this. Now, let us say on 40% syllabus completion. On 40% syllabus completion, what I will do is I will record the entry as debit advance received, credit revenue. Amount will be 40% of 50,000. That is 20,000. Understood? So this is how we do. Now, let us say I am done with another 40% syllabus completion. So I will pass the again same entry for the amount 20,000. And once 100% is done, so out of 50,000, I have recognized 40,000 as my revenue. I will now recognize the remaining 10%. Not the 10%, sorry, 10,000. Yes, I have already received money. Okay? Not full and final settlement. Now see, what this is what happens in case of service industry. As in when I progress with the service, I will be recognizing my revenue. Okay, understood? So this is actually something that all the educational institutes do. Okay, in India they have to follow Ind AS, which is actually directly copied from IFRS 15. Not a single word changes. So if you are learning IAS, IFRS, then you can even you are also learning Ind AS at this very same time. Okay. So tell me if you have any issue in this, the 5 steps. You cannot change the sequence, so the sequence remains the same. Okay. Now, example, on 1st December 2011, Wade receives an order from a customer for a computer as well as 12 months of technical support. So here, can I say there are two performance obligations? Firstly, the computer, and second, the 12 months of technical support. Wade delivers the computer and transfers its legal title to the customer on the same day. The customer paid $420 upfront. If sold individually, the selling price of the computer is 300 and the selling price of the technical support is 120. What is my reporting date? 31st December. Now, how do we recognize revenue? Okay, now they are saying, sorry, apply the 5 stages. So what is my step one? With the customer, or I'll just simply write identify the contract. So can I say Wade has entered into a contract from a customer to supply computer as well as 12 months of technical support. So Wade has entered into a contract to supply computer and 12-month technical support. Step two. Step two was identify the performance obligation. What are the performance obligation in this case? Supplying the computer and provide 12 months technical support. The performance obligations of Wade are is to supply computer and provide 12 months of technical support services. Okay. Next, step three. What was step three? Determine the transaction price. The transaction price is dollar 420. Okay. Step four was allocate the transaction price to separate performance obligation. Okay. So what is the transaction price for supply of computer? Dollar 300, sorry. And technical support service, dollar 120. Step 5 was recognize revenue as and when the performance obligations are satisfied. Okay. Now see, here there are two performance obligations. First one is supply of computer, and second is the technical support service over a period of 12 months. Now we are supplying, Wade is supplying computer on 1st December only. So he has transferred the legal title of the computer on the same day. So can I say the performance obligation for the supply of computer is done 300? Okay. Since the control of the computer is passed, I would rather say since the legal title of the is passed to the customer on 1st of December 2011, right? Or 2017? 11. Okay. Dollar 300 uh, revenue towards in Wade can recognize revenue of dollar 300 toward supply of computer. However, since the technical support services are to be provided over a 12 months, the revenue for the same will be recognized over 12 months. Okay. Uh, in the current financial year, only 1 month technical support service has been provided. So only dollar 10, that is dollar 120 divided by 12, can be recognized as revenue from the technical support service. The total revenue to be recognized is therefore dollar 310, which is dollar 300 plus dollar 10. Understood? Any questions? Now, every month, as and when the technical support services are provided, you will start recognizing revenue of 10. So, what entry will you actually pass on day one? Firstly, debit bank, credit what? Now, I tell you how things go. You have received money, 420. Now, day one only, uh, transfer of legal title of computer. Now you will recognize the entry as debit advance. Perfect. Yes. Two performance obligations, right? Uh, Provision of 1 month technical support provided. Understood? Now this entry you will be recognizing every month. Okay? Understood? Now we will be learning all these steps in details and they will be testing it in your exam. Okay? So let us now understand how do we actually identify the contract. So we will be learning all the steps in detail. Step one, identify the contract. Step two, uh, the performance obligations. Step three, the transaction price. Step four, allocate the transaction price. And then step five, recognize revenue. So this is something that we will be learning throughout this chapter. Okay. So identify the contract. Now see, the very first step in your revenue recognition is the identification of a contract, the existence of a contract. If a contract does not exist, you cannot recognize revenue. You cannot recognize revenue if a contract does not exist. Now, when can we say that a contract exists? When can we say that a contract exists? So, an entity can only account for revenue from contract if it meets all the following criteria. See, it meets all the following criteria. It does not say any of them. The first one is the contract should have a commercial substance. Now, what do I mean by commercial substance is the risk, timing, and the amount of cash flows are expected to change because of the transaction that you have entered into. Now, I am teaching SBR to my younger brother. Now, no doubt, this is a contract that I have entered into. But in this case, there is no commercial substance. So I cannot recognize any revenue with for any coaching services provided to him. Now, see, that's what. Even in case of NGOs, if you are providing any particular service to an NGO, you will be charging it, right? You will be charging them money. So you there have a risk, you have a timing, and also the amount of cash flows are expected to change as a result of contract. Now, what do I mean by commercial substance here over means is, in a way, if you are providing anything for free, please don't come into this. Okay, so the contract needs to have a commercial substance. Okay. Second, it is probable that the entity will collect the consideration. Means the other party is in a position to pay and you will be collecting the consideration. If you are not if it is not probable to collect the consideration, why do you want to record revenue at the first place and then reverse it off in the subsequent stage? If you know that you are not going to collect the revenue, okay, the chances of collecting the revenue are remote, then do not recognize revenue today itself. Now, here you will have to see the ability and the intention of the customer to pay. And this gets tested in your exam. Huh? They will give you a scenario like the customer is not having an ability to pay. They have already entered into a contract, but the customer is not having any ability to pay. It's not a bad debt, but you will say that no revenue should be recognized because the contract does not exist. This is how you will be saying. Okay. So it is probable that the entity will collect the consideration, that is money from the customer. Customer's ability and intention to pay that amount of consideration when it is due. Now, this criteria has the highest chances being tested in exam, where the customer may not have the ability to pay, and therefore the contract will not fall under IFRS 15. Okay. Now, you will have to look for information in the question regarding the customer's ability and intention to pay. The entity can identify each party's rights. Each of the parties' rights are identified over here. For example, for seller, the right for the seller will be the consideration, and right for the buyer would be the services or the goods, right? The parties have approved the contract. Now, it's not always necessary that the contract has been approved in writing only. It can be orally as well, or by the customary business practices, the same thing that we just discussed. And the entity can identify the payment terms, means the payment terms should be mentioned in the contract. Okay. So only when all these conditions are met, all these, conditions are met, then you can recognize revenue. So the mnemonic is CCRAP. C stands for commercial substance. C stands for probable that the consideration will be collected. R is rights of each party is identified. A is parties have approved the contract, and P is the entity can identify the payment term. All of these needs to be present before you start what I say is recognizing revenue. See, the first step is identify the contract. If the contract is only not existing, understood. So this is the exact first thing that you do, not in your theory standpoint, but in your practical standpoint as well. Okay. Any questions on this? Step one. Okay. Then step two, it is identify the separate performance obligations within a contract. Okay. Now, what do I mean by performance obligations? Now, these are promises to transfer distinct goods or services to a customer. Distinct means separate. Okay. Now, some contract may actually contain more than one performance obligation. Now, for example, let us say in our scenario over here, okay? Now, what is the performance obligation? What is my performance obligation over here? It is, I have only one performance obligation. That is deliver SBR lectures. I actually have other performance obligations as well. Provide mock support. Okay. Provide mock support. Now here I am having two performance obligations. First one is deliver SBR lectures. Second one is providing mock support. Okay. So this is how we will be identifying. In every what I say is contract that you enter, you need to see whether there are one performance obligation or two performance obligations, and there are criteria that needs to be met. Then only you can say that the promised goods or service is distinct. Now tell me, considering our terms and conditions, can you, firstly, can you benefit individually from either of the services on your directly on your own? If I just provide you deliver SBR lectures, will you benefit from this? Yes. Okay. Second, will you benefit directly from mock support services? Okay. Yes or no? Meaning to say, now what do I mean by benefit over here? Now see, what I have to see is whether the customer can benefit from the goods or services directly on its own or with the resources that are readily available. Can you benefit from deliver SBR from SBR lectures that I'm providing directly on your own because of this contract? Yes. Now mock support service. Can you take this mock support service from someone else instead of me? Yes, so that's what I'm saying. Now, what over here? See, let us say the fees that I charge was 50,000. So that is 40,000 towards delivering SBR lectures and 10,000 for mock support. Now, please try to understand what I am trying to say. See, I can say that both of these are separate. Both are of these are separate performance obligation only when number one, the customer can benefit from the goods or services directly on its own or with resources readily available. Now, what do I mean by with resources readily available? You can take these goods or services from someone else also. Okay? With resources readily available. And second one is the performance obligation. The promise is separately identified. Okay? The promise to provide both the services is separately identified in the contract. The promise is separately identified. Now let us try to understand what I am doing over here is I enter into a contract with you. I say that, okay, my price is 50,000, but I will be providing you both the SBR lectures and the mock support services. Okay. Now here, I am not having any separate performance obligation. Like I am having only one performance obligation, that is delivering the SBR lectures. Now mock support is the support service that I am providing. Now, in such a case, I will say that I have only one performance obligation, that is 50,000. Sorry, that is delivering lectures, and I will be recognizing my revenue as 50 on the basis of 50,000 only. Okay. Now, the terms and contract states that listen, the total price is 50,000, out of which I will be charging 40,000 towards delivering the SBR lectures and 10,000 towards the mock support services. Now see, as in when you make a payment, you will directly benefit from SBR lectures from me. But mock support service, can I say you can take it from someone else? If you don't want it from me, you can take this from someone else. And also, can I say, is the mock support here separately identified in the contract in the second scenario? The promise to provide mock support is separately identified. It is separately identified. So in such a case, I will treat both the SBR lectures and mock support services as two performance obligations. Now, in our case, I have put the contract as such that mock support is not separately identifiable. So I have only one performance obligation over here. No doubt I will be providing the mock support services. Okay. So, first one, some contracts may contain more than one performance obligation. For example, an entity may enter into a contract with a customer to sell a car, which includes 1 year's free servicing and maintenance. Second, an entity might enter into a contract with a customer to provide 5 lectures as well as to provide a textbook on the first day of the course. Okay. Now, distinct performance obligations within a contract must be identified. Now, a promised goods or service is distinct if the customer can benefit from the goods or services on its own or by using the resources that are readily available. And the promise to provide the goods or service is separately identifiable from the other contractual promises. Now, let us say I am someone I am having my electronic shop. So you entered into a contract with me for purchase of laptop and for purchase of mobile. Now, what I did is, in our case, I have two performance obligations. First one is the supply of laptop. Second one is the supply of mobile phone. Now, let us say I supplied you a laptop. Firstly, can I say both of the performance obligations, both of the promises are identified separately in the contract? Secondly, if I sell you laptop, are you benefiting from it on your own? Yes. So once I supply you a laptop, what I can say is I will now recognize revenue for laptop. Now talking about mobile phone. Now can I say this is a promised consider this is a promise what I said this is a promise which is separately identified in the contract. Now even if you don't purchase this mobile phone from me, you can purchase this mobile phone from someone else. So here I have two performance obligation, not one. That is supply of laptop and supply of mobile phone. Even though both of them is written in one contract only. Understood? Tell me if you have any doubts or questions. Hmm. Hmm. No, readily available means even if you are not taking this particular goods or services from me, can you benefit from taking that goods or services from someone else? You can. Okay. Understood? We solve an illustration, you'll get an idea. Now let us say Starling entered into a contract to build a school for one of its customers. To fulfill the contract, Starling must provide various services such as clearing the site, laying foundations, procuring the materials, construction, wiring of the building, installation of equipment, and decoration. Now, see, the question here is there only one performance obligation to build a school, or there are multiple performance obligations such as clearing the site, laying foundation, procuring the material, construction, wiring, and so on? Tell me. Think and tell me. Just don't give me the answer. Think of this. Think and tell me. Okay. Now apply these conditions. Are both these conditions satisfied? Only if yes, then you can treat all of them as separate. Else, no. Can the customer benefit from laying foundations on its own, procuring the materials on its own, construction, wiring of the building on its own? Now, what do I mean by on its own over here is does not mean वो खुद से कर रहा है. It means he can get it done from some another contractor. Can he get it done from another contractor? He can. He can. Coming to the second point. Now tell me, are these services or promises identified separately in the contract? The answer is no. Why? Because the contract is to build a school. So there is only one performance obligation to build a school. Understood? See, you can get all these services done individually from the separate contractors. For wiring, you will have some another contractor. For installation, you will have some another person. But are all these activities or promises separately identified in the contract? Are they separately identifiable? The answer is no. There is only one performance obligation, which is to build a school. So here, there is only one performance obligation, that is to build a school. Now, the customer can benefit from each of these services individually, evidenced by the fact that these services could be purchased separately from a range of entities. However, the services are not separately identifiable because Starling is being contracted to significantly integrate them into an identified output. See, the uh, contract is for the integrated output, not for the individual services. Okay. As such, Starling accounts for all the promised services as a single performance obligation. So what you have to do is if the customer can benefit from the goods or services on its own or by using resources that are readily available. And second one is the promise to provide the goods or services separately identifiable. Understood? Now, talking about principals and agents. Okay. Now, what happens in case of principals of agent is I want to start a new business in, let us say, Gujarat. I am dealing in electronic items in Mumbai. Now, it is not possible for me to uh, set up the entire business over there. I cannot buy a shop for now or something like this. So, what I do is I hire an agent, I appoint an agent. Listen, I am selling you my goods, sending you my goods. What you have to do is you have to sell these goods on my behalf. So, this is a kind of a consignment sales. I am a principal, I am the principal, I am appointing an agent. Okay. Now the question over here is, in case of principal and agent, how do we recognize revenue? Okay. How do we recognize revenue in case of a principal and an agent? Now let us understand. I am here, standing here. Bhavik Wagela. And let us say Isha. What I did is I sent you certain goods and I told you to sell these goods to the customers. And on each successful sale, I will be giving you a commission of 5% of the selling price. Okay. Now, what happens in this case is, let us understand from Bhavik's standpoint. When do I recognize revenue? Firstly, on goods sent to Isha or on goods sold, no, sold to the customers by Isha. Now, this is my question. Because see, when I send you goods and the date on which you sell the goods, the timing would be different. It's not possible that if I'm sending you goods today, you will be selling those goods today itself only to the customers. Even you will take some time, right, to sell these goods. Now, how do you recognize revenue in such a case? See, we learned that you can recognize revenue only on satisfaction of performance obligation. Now, here I have sent goods to Isha. My performance obligation is not satisfied. Okay. My performance obligation gets satisfied only when you pass the control or the legal title of the goods, of these goods to the customers. Right. So I will be recognizing revenue only when Isha sells goods to the final customer. Principal will recognize revenue only when Isha sells goods to the final customer. Okay. Obviously on the entire amount. So let us say sales price is 1000. So Bhavik recognizes revenue of $1000. Okay. Now let us talk from Isha's standpoint. Now what will happen is when Isha sells goods to customers, customers will pay 1000 to Isha. Isha will pass on the entire amount? No, you will pass on the net amount. Perfect. Where did you study this? Okay. Now, what will Isha do over here? Isha will recognize revenue only to the extent of the commission she is entitled to. You cannot say that entire 1000 is my revenue. You will say that only 50 is my revenue. That is 10,000 multiplied by 5% equal to how much? Not 10,000, it was 1,000, no? 1,000 multiplied by 5% equal to 50. Now, what you will do is you will be recognizing revenue of 50 and you will remit 950 to me. See, I will be recognizing revenue of 1,000 only. 50 commission, I will be treating it as my operating expense. That is commission given to the agent. Okay. This is the net money that I receive. I will have to show it gross. I cannot net it off. Revenue will be 1,000. Commission on the expense side will be 50. Understood? So with this, we are done with principal versus agent. An entity must decide the nature of each performance obligations. Now, this might be to provide specified goods or services itself, that is, it is the principal, or to arrange for another party to provide for the goods or service. Now, in this example that we just discussed, can I say you were providing an arrangement for me? You are arranging my goods for another customers. Okay, so this is agency sales. Okay, now entity is the principal if it controls the goods or services before it is transferred to the buyer. Now, the goods that I am sending you, okay, the goods that are lying with you, I am controlling these goods. It is just that I have transferred the possession to you. I did not transfer the ownership. Did I tell that I sold these goods to you? I did not tell that I sold these goods to you. I told that keep the possession with you. As and when you get some customers, sell these goods to them. Okay. So an entity is the principal if it controls the goods or services before it is transferred to the buyer. So I am principal. Why? I am controlling these goods. I can also require the return of these goods. I can call you, Isha, send me those goods back. I want to sell these goods somewhere else. I can do it. Why? Because I own these goods. I control these goods. I have the legal title of these goods. Now, this is important from the exam standpoint. You need to keep this in mind. Okay, that where it is the principal if it is controls the goods or services before an entity is the principal if it is if it controls the goods or services before it is transferred to the buyer, and if an entity is an agent, revenue is recognized based on the fee it is entitled to. Okay, I've just written a small example over here. Let us say I appointed Anupam from Chandigarh to sell goods on behalf of me. So I am principal and Anupam is the agent. Now let us say Anupam sold goods worth 1 lakh and he is entitled to commission of 7.5%. So what will he do is at the time of remitting me the amount, he will keep 7,500 with him and balance 92,500 to me. So Anupam's revenue is 7,500. My revenue is 1 lakh. Okay. Now this is the kind of question that was tested in your SBR past examination. Okay. Please try to understand. Now, what happens over here is I am a company who provides a cruise ship services. I have a cruise ship. Passengers pay me. They stay on my ship in my ship for 3 to 4 days. Okay. Now, to entertain my passengers, what I have done is I have appointed certain third parties that you can provide snacks, you can provide your parlor services, whatever kind of goods or services you want to provide, you can do it. Okay. Now, what I have done is I have told these third parties, do not charge any amount from my customers. You simply raise an invoice on me. So raise an invoice on Bhavik. Understood? Now, what happens in such a case is Let us say my cruise ship charges are 10,000. The consumption by the customers is 500. Now, what I do is the customers, the third parties charge 500 to the customers. Now, what I am doing is, see, I cannot let them sell their goods and services at free of cost. This is my platform. I will be charging some money from them because I am maintaining this ship. So I need to have some maintenance charges from them. So what I do is, let us say a particular customer made a consumption for 500. Now what I will do is, I will raise an invoice. I will raise an invoice as follows: 10,000 for the cruise ship services, 600 for the snacks and everything that you have, all the other ancillary services that you have consumed. So what I do is, I raise an invoice for 10,600 on my customer. Correct? Now let us understand, how will Bhavik recognize revenue? How much revenue should I recognize in such a case? The amount that I have collected from the customer is 10,600. How much revenue will Bhavik recognize in this example? You understood the entire scenario? Maybe this will help you. These two lines will help you out. Just read these two lines again, and then I come back to the scenario over here. Okay? Now tell me. Entire 10,600. Next का part with. So you are saying that I should recognize only 10,000 as revenue. But what about this commission that I'm charging? This is a kind of my commission only, right? Or the operating fees. What should I do with this then? This 100 is income for me, right? See, what was my actual snacks ka bill? 500. What I am doing here is I am charging a commission of 100. Now, why I am charging a commission of 100 over here? Because I am giving these third parties a platform to host their goods. So I will be recognizing a revenue of 10,000 towards the cruise ship plus 100 commission that I charged, a total of 10,000 and 100. Now this 500 that I have collected it on behalf of the third party. I will be remitting it back to them. Another thing, do I control these goods and services before they are being sold to the customer? The third parties control this, right? So an entity is its principal if it controls the goods or services before it is transferred to the buyer. So the third party is a principal over here. So see, Bhavik here is acting in two behalves. He is playing a double role. Firstly, he is a principal for the cruise ship services provided, and he is acting as an agent for the other services that are being provided. Okay. So Bhavik will recognize a revenue of 10,100. The third parties will be recognizing revenue of 500. Understood? So this is how they can twist some questions. So you'll have to, analyze the situation thoroughly. Any doubts or questions? So as Bhavik INC is acting as an agent for the food supplied, it should recognize revenue to the extent of the commission amount only. Okay, so what journal entry do I recognize in such a case? Debit bank or debit receivable 10,600, amount received or receivable. Credit revenue 10,100, the revenue recognized. And whatever is the amount that is payable to the food suppliers, I will credit payable. Okay, this is the entry that I will recognize. Let me know if you have any questions. Any doubts or questions? Okay. Now, talking about warranty services, are you an Apple user? Now, tell me what happens in case of warranty? What does the Apple tell you about warranty when you buy a mobile phone? Hmm. Hmm. You can get it replaced. Perfect. And do they give some additional extended warranty period services that are paid? Perfect. How much do they charge for that? How much? For 1 year, 15,000. My God, insane. Have you taken that? Okay. Let us understand the accounting treatment of both the warranties. Okay. Now, Apple Inc. I remember when I had iPhone 6, long back in the year, I'll tell you, 2017. They were telling me you can purchase the extended warranty services for 3,000 per year. So 3,000 to 15,000, almost 5 times a jump. Okay. Now let us say Apple Inc. when they sell mobile phone, they provide warranty services. First one is the free warranty service. And second one is extended warranty service. That is paid. Now see, the free warranty service that Apple is providing over here, it is an obligation for them. They are not going to receive any money for the warranty service that they provide, the free warranty services that they provide. So this free warranty service that is provided by Apple will be accounted for as per IAS 37 provisions, contingent assets and contingent liabilities. Sorry, provisions, contingent liabilities and contingent assets. They will have to recognize a provision as debit warranty expenses and credit provision for warranty. Okay? Because can I say they are not receiving any consideration for this? We have already studied this, IAS 37. So there also I had taken an example for Apple Inc. only. So debit warranty expenses and credit provision for warranty. Now let us talk about the extended warranty. Now see, in this case, Apple has charged you rupees 15,000 for how many months? Now in this case, Apple is liable to provide you warranty services over a period of 12 months. So in this case, can I say they have charged you money for this? So any extended or paid warranty will be recognized as per IFRS 15. Recognize 15,000 revenue over 12 months. That is every month 1,250. Understood? So this is about the warranties under IFRS 15. So if it's a free warranty, we account it for as per IAS 37. However, if it is a paid warranty, Apple is now having an obligation to provide you to provide not free, sorry, to provide the support services, the warranty services for the mobile phone. Most of the time, a warranty is an assurance that a product will function as intended. If this is the case, then the warranty will be accounted for in accordance with IAS 37. If the customer has the option to purchase the warranty separately, then it should be treated as a distinct performance obligation. This means that a portion of a transaction price must be allocated to it. Okay. Now let us say you have purchased a mobile phone for 1 lakh. So with this, you get free warranty services for 1 year and you extend your warranty for 15,000. So how much have you paid in total is 1,15,000. Now what will happen is 1 lakh entire will be recognized by revenue on day one itself and remaining 15,000 will be recognized over a period of 12 months. The same example that we had just discussed here. That this illustration. Okay. Tell me if you have any question. We are done with principals and agents. We are done with warranties. You'll have to scroll the notes to the right hand side. Huh? I have tried to put all the content for a particular step on one slide only, or else it would have become. Now, talking about step 3, determining the transaction price. Okay. So, determining a transaction price, how do we arrive at the transaction price in to be recognized for revenue? First one is variable consideration. Second is significant financing components. Third is non-cash consideration. Fourth is consideration payable to a customer. Now, what do I mean by variable consideration? Now, many institutes where I conduct the lectures, they give me a condition. Okay. They give me some variable compensation as well. So, in addition to the hourly compensation, what they tell me, if the the pass rate is more than the global average, meaning to say SBR pass rate for SBR is 50% globally or 48% globally. But I am able to achieve a pass rate of more than that rate. So let us say I am teaching in ABC Institute. There were 100 SBR students. Out of these 100, 90 have passed. So my pass rate achieved is 90. But the global pass rate is 48. This means I have performed well. Now, in this case, I will be entitled to a variable consideration, which will be, let us say, 50,000. Okay. Now, the question over here arises is, let us say they are paying me 2 lakhs for the lectures to be conducted. Now, this is my fixed component, not a fixed cost, fixed component. And this 50,000 is my variable component. The question today that arises is, should I recognize 2 lakh as my revenue or I should recognize 2,50,000 as my revenue? This is the question in front of us today.
Variable is depending on like after like
You are saying 50,000, it depends, it is not happening today, it's happening in future. So you need to recognize it in future only. अगर ऐसा ही होता तो स्टैंडर्ड कुछ बोलता ही नहीं. What does the standard say over here is the entity needs to make a judgment regarding has it achieved certain such variable compensation in past. Okay. If yes, then include the variable compensation also today in your transaction price. If no, then what you need to do is recognize this revenue as in when it is received. 2 lakh you will be considering. See, I'm not concerned with 2 lakh. I'm concerned about the variable. Should I include it today or I should wait for the future? So based on the past experience or past experience of the entities, it needs to determine, were we able to achieve this kind of activity in past? If yes, then recognize it. If no, then do not recognize it. Okay. Now let us come to the wordings of the standards. And these are the wordings that you will be writing up. IFRS 15 says that this estimate can only be included in the transaction price if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. Now, what do I mean by this? Let us say you recognized a revenue of 2,50,000. Now you are not able to achieve your target. Okay. So can I say this is my cumulative revenue recognized? Now what is happening is I will now have to reverse this revenue to 2 lakh. Why do you want to reverse it at the first place? Why do you want to reverse it at the first place? So that's what I am saying. They are saying that only if it is highly probable that the reversal will not occur, then only you recognize the revenue. Now, how will you know that the reversal will not occur? When the uncertainty is resolved on the basis of your past estimates. Okay. If a contract includes variable consideration, then an entity must estimate the amount it will be entitled to. Okay. Understood? So IFRS 15 says that this estimate can only be included in the transaction price if it is highly probable that the significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. Now, what do I mean by uncertainty is resolved? Once you achieve your global pass rate. Okay, once you get to know the result. Note that if a product is sold with a right to return it, then the consideration is variable. Now, the entity must estimate the variable consideration and decide whether or not to include it in the transaction price. Okay. The refund liability should equal to the consideration received or receivable that the entity does not expect to be entitled to. Now, for this, we will be solving an illustration. You understood this? We take first question. Bristow has experience of providing identical services in the past, and it is highly probable that the number of mistakes made will fall below the acceptable threshold. On 1st December 2011, Bristow provides a service to a customer for the next 12 months. The consideration is $12 million. Now, Bristow is entitled to an extra $3 million if after 12 months, the number of mistakes made falls below a certain threshold. Now tell me, in this case, how much revenue should Bristow recognize in case A? 15. Okay. Why?
It's highly probable that it will not.
Mistakes made will fall below the, and again, this 15 million will be recognized over a period of 12 months. Now, can you help me out in drafting the answer? Write it out in your notebook. I'm giving you 2 minutes. I want you to write it out in words. How will you write as per the requirement of the standard? Then, then what will you write next? This is just the requirement of the standard. Now, how will you link it to the scenario? How will you link it to the scenario now? I'm coming back to the scenario over here. Write it down. Comma. In the given scenario, comma. Bristow has agreed to provide. See, you will write like this. In the given scenario, Bristow is providing services to service to a customer over a period of 12 months, where the fixed consideration is $12 million if the number of mistakes. ये ऐसे लिखोगे आप लिखो एक बार लिखो आपके वर्ड्स में आई वांट टू सी द आंसर ड्राफ्टिंग प्रैक्टिस किया डिड यू स्टार्ट प्रैक्टिसिंग द क्वेश्चंस स्टार्ट इट डोंट डिले each and every day is important. So you could have done two questions so far, three questions हो जाते टाइप करके.
Right? Two times in the given scenario. Ratio.
Can I read what you have written? Hmm. IFRS 15 says that this estimate. You cannot write this estimate. You will write, as per IFRS 15, variable consideration can be included in the transaction price only if. ऐसे लिखना है ना? It is highly probable that a significant reversal in the cumulative revenue recognized will not occur when the uncertain. In the given scenario, Bistro is providing the service, which is providing service which is for the next 12 months. The fixed consideration in this case is dollar 12 million for name, and variable consideration is dollar 3 million. If the number after 12 months तो नहीं लिखना चलेगा. Is 3 million variable consideration is $3 million. See, you could have written, I'll tell you. See, this is, how you draft your answers professionally that will help you fetch more marks. How would I have written it? In the given scenario, Bistro is providing services, will be providing services over the next 12 months. For this, he will be entitled to a fixed compensation or consideration of $12 million. However, if the number of mistakes made falls below a certain threshold after a period of 12 months, he will be entitled to a further $3 million variable consideration. So you see, it's the same thing only what you have written and what I have written. But the way you present your answers, it helps you fetch you more marks. And maybe that makes a difference between 48 and 52. So many a times what happens is, if see, ACCA will try to keep a check or control on the results as well. They don't want to flood the market with many ACCA. So to control the result, they then go for this language also. Okay. So try to be as professional as possible. Just think that some director or other person is sitting who is having no such idea. How will you be able to explain yourself just by writing the answer? They need not call you or text you. I did not understand what you have written. So it should contain all the details there. Okay. So you'll have to work on this thoda sa part, hai na? So this is how I have drafted the answer. IFRS 15 states that variable consideration is pura part. Now, in the given case, Bristow has experience of providing identical services, and it is highly probable that the number of mistakes will fall below the acceptable threshold. So, in this case, variable consideration of $3 million should be included in the transaction price. So, a total of $15 million should be recognized as revenue over a period of 12 months. So, for December 2011, only 1.25 million of revenue will be recognized. Okay, because we have started this from 1st December. My year ends on 31st December. So 1 month has gone by. So what is the entry that I will recognize? Debit bank or receivable 15, credit revenue that I have eligible to recognize, and rest I treat it as my advance income. Understood? Now in second part, they are saying that Bristow has no experience and is unsure. So now I will not be writing the entire part. I won't be stating the requirement of the standard again. You will just write that, okay, Bristow has no experience of providing identical services, and it is ensured that the number of mistakes made will fall below the threshold. So in this case, variable consideration should not be included in the transaction price. Only 12 million will be recognized. Okay. So what if $3 million is received in future? So you recognize it as revenue when it is received. Okay. So you'll have to write this point also. The $3 million will be recognized in the future if it is received. Okay. Next and the last question we take for the day. What time do you have to reach your office by? 10, no? You want to leave? पहुंच जाएगी 30 minutes में. ठीक है. चले हाँ तो ठीक है. How should the above transaction be accounted for? Now Nardon enters into 50 contracts with customers. Each contract includes the sale of one product for $1,000. The cost to Nardon of each product is $400. Now cash is received upfront and control of the product transfers on delivery. Customers can return the product within 30 days to receive a full refund. Nardon can sell the returned products at a profit. Nardon has significant experience in estimating returns for this product. Now it estimates that 48 products will not be returned. So can I say in this case, you will not be considering revenue for the entire 50 contracts. Only for 48 contracts. Rest two, you will be having a look. So what entry do I recognize for this is, when I receive money, I will recognize the entry as debit bank, credit revenue, and listen, I am not sure of the 2 units that I have sold. I have received the money today, but if the customer returns those goods back to me, I have to refund that amount. So bank I will receive is 15 multiplied by 1000. Revenue 48 multiplied by 1000. And I will have to recognize a refund liability for 2000. I may have to refund this amount in future. And can I say, see, out of the total 50 items that I have, 48 are sold. And two, I have sold with right to return. See, if I recognize revenue, then I have shown an outward movement of my inventory. Now, if I don't record a journal entry for this transaction, then my inventory records will not match. It will not match. Okay, what will happen is my physical inventory will show uh, an outflow of 48, but my physical inventory will show an outflow of 50 units, but my accounting records will show an outflow of 48 units only. So I have to record an entry. I will have to show an outward movement of these goods because these goods are not with me. So what I do is I will credit inventory at cost only, obviously. And the cost in this case is 400 per unit. Okay, so 400 multiplied by 2. But I also have the right to receive these goods. And this right to receive will be shown in balance sheet. So I'll have to pass the entry as debit right to receive goods and credit cost of sales. So for every sale of goods with a sale right to return basis, okay, with a sale on return basis, you will be recognizing this journal entry also, which is debit right to receive goods and credit cost of sales. Now this is your asset. You don't have the inventory with you today, but you have right to receive the goods. Understood these two journal entries? Now let us see what if the customer does not return the good. If the customer does not refund the good, means he has accepted the goods. So firstly, I will be receiving this, reversing this journal entry because can I say my right to receive the goods have now extinguished? So first journal entry that I record is debit cost of sales, credit right to receive goods. 400 multiplied by 2. The cost of each item is 400 and 2 units. Okay. So firstly, you will reverse this journal entry because you no longer have the right to receive the goods. And second, debit refund liability, credit revenue 2000. Okay. So just have a look at these two journal entries. Okay. Next, if the customer returns the goods, now in such a case, the customer has returned the goods. Now again, can I say I'll have to reverse this journal entry because I now have this inventory back with me. So I will reverse this journal entry firstly. Secondly, whatever is the refund liability, I will debit it. So debit refund liability and credit bank and credit. So this is how the accounting will be done. Okay. Okay. Now see, this is just for understanding random amount that I have taken. Whenever you purchase goods, what journal entry we have learned till date was debit purchase, credit trade payables. That is not the case. Actually, it is debit inventory and credit bank or payable in practice. I don't take this amount to purchases right now. I first take it to inventory. Now, when I sell the goods, I have to record the cost of the sales. I have sold certain goods. I will have to recognize the cost of those goods. Okay. So debit cost of sales and credit inventory. The goods have gone out, right? So I'll have to credit inventory and I will debit cost of sales. And when I actually sell the goods, debit receivable or bank credit revenue. Understood? So with this, we are done with the variable consideration. Now, step 3, we are done with variable consideration. Tomorrow, we will be starting with the financing component. Okay. Then we have non-cash consideration and consideration payable to a customer. Okay.